What's going on, everyone? Welcome back to the show. So about a month ago, I posted a video where I was talking about a California bank that basically had to close their doors it was temporary, it was about a day, and people couldn't get their money out. And so today I want to focus on another California bank, and this is much worse, much worse. And we're going to talk about this because is this a sign of something that we're going to be seeing on a regular basis in the future? So that's what we're going to focus on when it comes to this bank. And is this contagious? Are we going to see other regional banks, other smaller banks do the same thing? So that's what we're going to focus on in this video. But first off, if you guys can do me a favor, please like the video, subscribe to the channel, hit that little bell notification, and then click all. By clicking all, you'll get notified anytime we post a video. We do daily videos here, so by clicking the bell notification and clicking all, you should be getting updated every day. And so I'm going to show you this clip, and then we're going to talk about some of the ramifications that we might see in the near future when it comes to banks. Here we go.
Alarm outside headquarters of Silicon Valley Bank in Santa Clara, California today.
They just came out and told us that the bank is shut down.
SVB, the 16th largest bank in the U.S. with $175 billion in deposits, is now the biggest American bank to fail since the 2008 financial crisis. Its customers are primarily businesses and investors in the tech sector.
The root cause of the failure here was a sudden and significant increase in interest rates, which that part of the job of a bank is to manage interest rate risk, and that didn't happen here.
Earlier this week, SVB disclosed it took a loss on the sale of bonds due to rising interest rates and announced it would sell shares to shore up its balance sheet. Its stock price plunged and customers rushed to take their money out. The FDIC now stepping in, telling customers they will be able to access funds by Monday, but the guaranteed amount per depositor, $250,000.
A heart-stopping moment of this bank is done.
Ashley Trunier is the CEO of healthcare startup Farmbox RX. Unable to access her money today, she fears she could be out more than $10 million.
$250,000 isn't a ton of money to us when you're talking of 8 figures that's in the bank currently.
Concern over today's collapse of SVB drove Wall Street lower. The banking sector alone down more than 4%. Treasury Secretary Janet Yellen.
There are recent developments that concern a few banks that I'm monitoring very carefully.
The immediate concern? The cash-burning startups who have millions in SVB and may not be able to access the money they need to pay bills or make payroll.
Deirdre, given what happened today, how much concern is there about the banking sector overall?
Lester, at this point, the issue seems contained to this one bank. SVB was so heavily focused on these startup tech companies that its business model put it in a risky position that the major banks don't face in the same way. Lester?
Deirdre Boza tonight, thank you.
And so hopefully this explains why Silicon Valley Bank collapsed. And basically what happened is you have a lot of people going to the bank, a lot of customers going to the bank trying to get their money out. And as they were pulling their money out, the bank needed to sell off a lot of the bonds that they had, and they were losing money selling the bonds because it was like a long-term investment. And so because the bond didn't mature, when they were pulling all that money out, they're losing money. And so the bank got to the point where they couldn't give out any more money. FDIC steps in, and then they pretty much shut the bank down. And so that's what we're looking at right now. Now, you saw there they were talking about the $250,000. So FDIC will insure up to $250,000. So if you have money in the bank, and this is for all banks in the U.S., if you have money in the bank, FDIC will insure up to $250,000. Now, the problem with this bank is you have a lot of startup companies, you have a lot of companies in general that have their money in that bank. And so a lot of those companies have more than that $250,000. So even if the $250,000 is insured, they might lose. Like the lady was saying, she's looking at losing $10 million. They might lose that money. And where does all that money go to? That money goes to, a lot of it goes to the employees. And so we're going to see some of these companies, we'll have to see what happens when it comes to if this bank will be bought out by another bank, and then hopefully they'll be able to provide the funding for all these different companies that are going to lose their money if no one buys them out. And so this bank can have a major impact on all these startup companies. And some of these startup companies might actually shut down. And what's going on with the startup companies, a lot of these startup companies, they're not profitable. Now, where it gets dangerous is when these startup companies, because they're not profitable, they're pulling out more money than usual to make payroll and things like that. And then they start hearing rumors of the bank might be struggling. And so now they're going to the bank and pulling out even more money because they're in fear that this bank, this Silicon Valley Bank, doesn't have the money that they might claim to have. And so more and more businesses go and they start pulling out their money. And before you know it, the bank collapses. So will we see this in other areas, in other banks? Because if you have a bank that's specific, this is more of a specific bank for businesses, that's one thing. But what about a bank that is just your average run-of-the-mill bank where you go and you have a lot of the consumers are basically us. You know, we go in and we put our money in that bank. Well, like I was saying, $250,000, FDIC will insure. So you should be safe when it comes to that as long as you have less than $250,000 in the bank. Now, if you have more than that, why not put $250,000 in one bank, $250,000 in another bank, $250,000 in another bank, $250,000 in another bank? That way, $250,000 is insured, so you won't be in a situation where you're going to lose that whole $1 million, or let's say $750,000, because you only have $250,000 insured. So this is something that we're definitely going to continue to follow, and we need to follow, because when it comes to the banking industry, I mean, they're doing a lot of the same things. They invest money. So if I give you, let's say if someone gives me $100, we'll just say I'm the bank. Someone gives me $100, I might keep $10 and just keep it in the bank or just keep it in my house, and then I'll invest that $90 into something else so I can make money on that. Okay, and so that's what's happening. So they're investing money so they can make money. But if it goes wrong and if it's a long-term investment and they can't pull that money out without a penalty and you want your $100 back, I'll have to take money out of that investment and there'll be a penalty. So I'm going to lose money on that. And then I still have to give you your $100 back. And so it's just, we'll have to see if other banks are going to be in a similar situation. And if that is the case, are we going to have people running to the bank just to get their money out? And so we'll have to see where it goes when it comes to this. But I just wanted to talk about this because I talked about it previously, like a month ago, with another bank, and it was only a temporary thing, and it looked like it was a glitch. But this is not a glitch. This is actually a bank collapsing in front of us. And so is this going to be a start of something that we see in the future? Now, another thing, these larger banks, they're more diversified. So even if there was a situation like this, they have money spread out all over the place. And so in most situations, they'll be able to handle any type of, or we'll say weather this storm if there was a situation where people ran to the bank and tried to get all their money out. And another thing we have to start thinking about, is this bank too big to fail? It's the 16th largest bank in the U.S. Will the federal government, if no one buys it out, if you don't have another company, another bank come in and buy this bank, will the federal government have to step in and actually buy the bank or pretty much secure all the money that the bank will be losing? And basically that's taxpayer dollars that are going to have to go to this because they're too big to fail. If we allow them to fail, then we're going to allow all these businesses to go under. And so are we going to be in a situation where we're going to have the federal government have to step in if you don't have another bank step in and buy this bank out? So we're going to have to watch this. Monday is going to be very, very important for us to pay attention to what's going on because that's when we'll find out what they're going to do with this bank. Right now, the FDIC has shut the bank down and they're in control of the bank. And so we'll have to see what happens in the future. But I want to know what you guys think about this. What do you think about this bank collapse? Do you think this is just a start and we're going to start seeing more banks collapse in the future? Let me know in the comments below. If you like this video, please give me a thumbs up. Please subscribe for more, and I'll talk to you in the next one. Bye.